Hey everyone, welcome back. Today, we're diving into a forgotten chapter of financial history, a story of ambition, power, and how two titans of industry, in a secret war for control, inadvertently brought Wall Street to its knees. Picture this, the dawn of the 20th century in America, an era of unprecedented growth, but also cutthroat competition. Railroads were the lifeblood of the nation, and controlling them meant unimaginable wealth and influence. This wasn't just about tracks and trains, it was about dominion over commerce, agriculture, and the very shape of America's future economy. Our story centers on two colossal figures, James J. Hill, often called the Empire Builder, who dominated the Great Northern Railway across the American Northwest. His rival, Edward H. Harriman, a shrewd financier who had seized control of the Union Pacific. These weren't just businessmen, they were strategists, visionaries, who saw the continent as a chessboard, each vying to connect their lines, control vital shipping routes, and corner lucrative markets. Their rivalry was legendary, often simmering beneath the surface, but always intense. The prize that would ignite their conflict was the Northern Pacific Railway, a sprawling, strategic line that connected the Great Lakes to the Pacific Northwest. Controlling it would give either Hill or Harriman a near unrivaled transcontinental network. Hill already had a significant stake, as his Great Northern shared tracks with Northern Pacific. But Harriman saw an opportunity to extend Union Pacific's reach, forging a truly dominant system. What began as quiet maneuvering soon escalated into a high-stakes, clandestine stock market battle, unbeknownst to most of the financial world. The objective was simple: acquire a controlling interest in the Northern Pacific common stock. Hill, through his powerful allies, including J.P. Morgan, began quietly buying shares. Harriman, equally determined and backed by the formidable Kuhn Loeb and Company, did the same. This wasn't a hostile takeover in the modern sense, but a strategic accumulation. Each side believed they were simply outmaneuvering the other, picking up shares from unaware investors. Little did they know, their combined buying spree was setting the stage for an unprecedented market phenomenon. The Northern Pacific Railway had two classes of stock, preferred and common. Hill initially bought preferred stock, but Harriman focused on the common stock, realizing it held the true voting power after a certain date. Harriman's strategy was to buy enough common stock to gain control. This shift in focus would become critical. As both sides continued to accumulate, the available float of Northern Pacific shares began to shrink dramatically. The market, however, hadn't yet grasped the extent of what was happening behind the scenes.
Many investors, particularly speculative short sellers, saw Northern Pacific's stock price rising steadily and assumed it was overvalued. They borrowed shares, sold them, and bet that the price would fall, allowing them to buy them back cheaper and pocket the difference. This short selling is a standard market practice. But what these short sellers didn't realize was that Hill and Harriman were not just buying, they were hoarding shares, effectively removing them from circulation. They were unknowingly stepping into a trap, a classic corner of the market. A corner happens when a single entity or group buys up virtually all available shares of a company. When short sellers then need to buy back shares to fulfill their obligations, a process called covering their shorts, there are almost no shares left to buy. The few available shares can then be sold at exorbitant prices by the cornering party, forcing the short sellers into ruin. In the Northern Pacific situation, neither Hill nor Harriman intended to create a corner. They simply wanted control, but their combined efforts achieved the same devastating effect. The fuse was lit. As May 9, 1901 dawned, the pressure began to build. Short sellers who had bet against Northern Pacific now frantically tried to buy shares, only to find virtually none available. The price, already elevated, began to climb vertiginously. It wasn't just a rise, it was a vertical ascent. From a respectable $150, the stock rocketed past $300, $400, even $600 a share in a matter of hours. This was unprecedented. Panic was about to grip Wall Street. On that fateful Thursday, May 9th, the Northern Pacific Railway's common stock became a symbol of market madness. The New York Stock Exchange floor transformed into a maelstrom of desperate shouts and frantic bidding. Brokers representing the trapped short sellers were authorized to buy shares at any price, no matter how ridiculous, to avoid total bankruptcy. They had to cover their positions before the end of the trading day. The frenzy for Northern Pacific shares drew capital away from other stocks, causing a broader market decline. As Northern Pacific shares surged towards $1,000, the rest of the market plunged. Investors, seeing their portfolios of other solid stocks rapidly losing value, began to sell indiscriminately. This was the true panic, not just a single stock going crazy, but a systemic fear spreading like wildfire. Banks began calling in loans, fearing a widespread collapse. Many smaller brokerage houses faced insolvency. The financial system was teetering on the brink, threatened by a battle only a few at the top truly understood.
The crisis was exacerbated by the lack of clear communication and regulatory oversight common in the Gilded Age. There was no Securities and Exchange Commission, no circuit breakers, no federal safety nets. Financial magnates operated with immense, largely unchecked power. The public, witnessing the chaos, was terrified. This wasn't just about a few rich men losing their fortunes. It was about the stability of the entire American economy. The fear of contagion, a rapid domino effect, was very real. At the peak of the panic, Northern Pacific common stock briefly touched $1,000 a share, an unheard-of valuation for a railway. Imagine the despair of those short sellers who had to buy at that price, knowing the true value was far, far less. Their ruin was complete. Many were utterly wiped out. This single stock had become a black hole, sucking in capital and crushing reputations. The question wasn't just how this happened, but who could possibly stop it. Enter J.P. Morgan. While his firm was aligned with Hill, Morgan was above the petty rivalries when the entire system was at stake. He saw the impending catastrophe. This was not a moment for victory laps or settling scores. It was a moment for leadership. Morgan understood that if the panic continued, it would drag down not just a few brokers, but major banks and ultimately the entire American financial system. He had to act, and he had to act decisively. Morgan quickly summoned the city's leading bankers and financiers to his offices. This was an emergency council, a war room for the financial elite. His message was clear. They needed to pool their resources, stabilize the market, and critically, find a way to resolve the Northern Pacific standoff. No single entity could weather this storm alone. It was a stark reminder of how interconnected the financial world was, even in an era before modern communications. The immediate goal was to calm the market. Morgan and his allies began injecting massive amounts of liquidity, buying up other stocks that were being indiscriminately sold off. This show of strength helped to reassure fearful investors and stem the broader market freefall. It was a classic example of a central banking function being performed by private individuals, demonstrating the immense power and responsibility held by a few key figures in the absence of federal intervention.
Simultaneously, the pressure was applied to Hill and Harriman. Morgan, along with Jacob Schiff of Kuhn Loeb & Co., brokered a truce. Neither side had achieved absolute control, and both had inadvertently created a catastrophe. The solution required compromise. An agreement was reached that evening. The two rival groups would pool their Northern Pacific shares and form a new holding company to jointly control the railway. The new entity was called the Northern Securities Company. This holding company would control not just Northern Pacific, but also the Great Northern, and, indirectly, elements of the Union Pacific through its influence. It was designed to end the cutthroat competition and bring order to the chaotic railroad industry. This seemed like a brilliant solution to avoid future panics, consolidating power and ensuring stability. But it wouldn't last unchallenged. The formation of the Northern Securities Company, while ending the immediate crisis, inadvertently set the stage for a different kind of battle, a legal one. President Theodore Roosevelt, a staunch advocate for antitrust reform, viewed such massive corporate consolidation as a threat to free markets and competition. He saw the Northern Securities Company as an illegal trust, a monopoly that stifled enterprise and harmed the public interest. The government was about to take on the titans of industry. In 1902, the Roosevelt administration filed a lawsuit under the Sherman Antitrust Act against the Northern Securities Company. This was a landmark case, signaling a new era of government intervention in big business. The legal battle was fierce, pitting the nation's most powerful financiers against the federal government. It was a test of wills and a definition of the limits of corporate power in a burgeoning industrial nation. The outcome would set precedents for decades to come. Finally, in 1904, the Supreme Court ruled against Northern Securities, ordering its dissolution. This was a monumental victory for the Roosevelt administration and a clear message to corporate America: no entity, no matter how powerful, was above the law. It marked a significant turning point in American economic history, ushering in the trust-busting era and laying the groundwork for more stringent financial regulation in the years that followed.
The Panic of 1901, though short-lived, served as a stark warning. It exposed the fragility of a financial system dominated by a few powerful individuals and the dangers of unchecked market manipulation, even when accidental. It underscored the need for greater oversight and regulation, lessons that would slowly be absorbed and lead to significant reforms in the coming decades. The market had almost broken, not by external forces, but by internal financial warfare. For ordinary investors and the public, the Northern Pacific Corner was a brutal lesson in market volatility and the risks associated with speculative trading. Many lost their life savings, caught in the crossfire of a battle they couldn't even see. It highlighted the systemic risk that can arise from concentrated financial power and the devastating impact it can have on Main Street, even when it originates on Wall Street. The story of the Northern Pacific Corner is more than just an old railroad dispute. It's a profound look into the very DNA of financial markets. It reveals how the pursuit of control, the intricate dance of stock accumulation, and the unintended consequences of high-stakes maneuvering can cascade into widespread chaos. It's a testament to both the extraordinary power of Gilded Age magnates and the nascent realization that this power needed to be tempered. Ultimately, the Northern Pacific Corner pushed America closer to understanding the need for robust financial architecture and effective regulation. It contributed to the ongoing debate about trusts, monopolies, and the role of government in balancing economic growth with public welfare. It's a reminder that while ambition can build empires, it also carries the potential for catastrophic instability, demanding vigilance and a framework to protect the broader economy. This dramatic episode illustrates a timeless truth. Financial systems are inherently fragile, and the pursuit of individual gain, when unchecked, can have devastating ripple effects far beyond the boardroom. It's a lesson we revisit time and again, from the Roaring '20s to the dot-com bubble, proving that the struggle between power, profit, and stability remains a constant, vital challenge in the world of finance.